What's going on YouTube? Mike here, back again with Renegade Forex and our first episode of our free Smart Money Concepts Forex trading course. And so in this video, what we're going to be going over is break of structure, or also known as break of market structure. And this is step 1 in 5-step Forex, a free Smart Money Concepts trading course. So be sure to check out the domains 5stepforex.com as well as renegadeforex.com for more resources that I offer outside of this YouTube channel. So a quick overview of what we're going to be covering in this episode today. We're going to be talking all about break of structure and what that means, how you can use that to actually map structure and accurately predict the most likely direction that the market is going to go. What characteristics we see after a break of structure, the different types of candlestick closure on a chart and what they mean. We're also going to include visual examples of a break of structure in this slide deck. We're also going to talk about the difference between a wick and candle body close. So there's two very distinct differences between a wick and a candle actually closing, and we're going to go into what that means. And in the next video, what we're going to go over is actually walking through live charts and applying this to a live chart. So if you haven't caught on yet, the main layout of this free course is going to be, the first video is like an actual slide deck talking about the information of the specific topic. And then the second video is an actual live chart walkthrough where we apply what we learned to a live chart. So that way you can get the visual, note-taking side of it with the slides, and then you can also see a live chart and how to apply the specific concept or each specific step of the course to a live chart. Okay, so what exactly is a break of structure? A break of structure, or otherwise known as a break of market structure, is when smart money forces the market up or down depending on the swing trend and direction of the market via aggressive buying or selling to break an old range and start a new range. This can be seen as forming a new high or low in the market. This obviously gives us the upper hand in helping to see which direction large institutions are trading on that given time frame. Okay, so now how can you use this to actually map market structure and predict which way the market is most likely to go? After a break of structure, we can then determine the likely direction for the trend to continue on that time frame. We do not enter at the breakout. That's a very key point to a break of market structure, is we are not breakout traders. This is just simply an action that we can spot smart money doing in the market to predict and frame a trade for the market direction. This is why many breakout strategies fail, as you'll see as we actually go through our different scenarios, and then in the next video in the live chart walkthrough, I think you'll start to see why breakout strategies fail. And so finally, a break of structure is caused by aggressive buying or selling, which automatically indicates the direction that smart money is most likely taking the market. So if you see on your chart a break of structure and it's going long or up on the chart, then we can accurately predict that that's the direction that smart money is going to be taking that chart on that time frame. Okay, so the next part of the lesson is talking about what we actually see after a break of structure. When we get a break of structure in the market, we can usually, most of the time, see the time frame it happened on will experience a pullback into the newly created range. Again, this is why breakout strategies fail. As soon as you see a breakout, you can automatically anticipate that that time frame will experience a pullback into the newly created range. So that's something that you can just automatically put in the back of your mind. Every time you see a break of structure, you can just anticipate a pullback is most likely going to happen. It doesn't have to happen every time, and there are instances where it does not happen, but almost every time we see a break of structure, eventually price will pull back into a supply and demand zone, which we'll go over in later episodes. And this is due to institutions mitigating orders, and they're mitigating supply and or demand zones and closing their initial buy to sell orders or sell to buy orders to continue the move in the direction that they initially broke structure. We go over this more in future videos and in the full course that I have, but for now, we're going to kind of just try to keep this simple and go over a few simple examples in the coming slides. So before we get into actually showing and going over breakup structure, we need to actually talk a little bit more about candlestick closure. And so in order to actually accurately define a breakup structure, it does depend on the type of candlestick closure above or below old highs and lows. So oftentimes we see price wick a high or low or a specific candle within a range. And a wick is not a breakup structure when it comes to structure mapping. We will discuss wicks and how they do mean something in regards to change of character in future videos. But for now, we need to think of a wick as a failed higher high or a failed lower low. A wick is basically, in most cases, a liquidity grab to take the stop losses of traders trading with or opposite the direction of smart money. Or they're also triggering orders to open at the breakout and then taking those orders back to hit the stop losses. So let's go over a few examples of candlestick closure before we actually get into breakup market structure. So this is an example of wicks, and you can see on the image here, this candle came down and it wicked this old low and then retraced back up and closed back within this range. And so we'll go over ranges in future lessons. But for right now, we just need to understand that this was an old low. You can depict this low by this pullback here, and then it continues this direction, comes back here, and it spikes that low. And this actual candle body here retraces back up and closes above this low. So this is not a breakup structure. This is simply price wicking an old low. So here are examples of actual true break of market structure. You can see from this low directly across to this candlestick pierced that low and it actually closed below this old low here. This is defined as a clear break of structure. And so there's a few examples here. And this is also just a trending market. And so you'll start to notice as you go through the rest of this lesson and apply it to your charts that this is happening all the time on all time frames. And it does happen in both bearish and bullish examples. But in this lesson, I'm only including a bearish example. Okay, so a further explanation of wick and candle body close. If a candle closes above or below an old high or low, that is considered a break of structure. If a candle wicks an old high or low, and that candle retraces into the range without actually closing above or below the old high or low, that is not a break of structure. That is a liquidity grab. As soon as price trades 1 micro pip above or below an old high or low and closes, that is a break of structure. So in some cases, it doesn't have to actually be so aggressive and close so far down, but we need to know this for our rules that even if it's just 1 micro pip down below this old low, so if you cut this candle like in half and it's still closed below this old low, then that still counts as a break of structure. Sometimes a break of structure is not obvious. Other times you have to actually zoom in and actually read the price it closed at to tell. And so that's kind of what I was just saying. Sometimes it's not going to be like a super obvious extended candle piercing into a new range. It may just be 1 micro pip that it closed below, but that's still important to know because there is a clear difference between a wick and a break of structure. And if it broke structure 1 micro pip below or above an old high, then that is still considered a break of structure. Okay, and so this wraps up our overview, our slide deck of what a break of market structure is. And in the next video, we're going to actually go over live chart analysis and do about 20 or 30 minutes of actually marking break of structure and talking about break of structure and show you how to mark it as well. I'll review multiple examples and multiple time frames in the next video. And I also want you to always remember throughout this free course that this information and these concepts applies to any time frame and any chart. So it doesn't matter what you trade, it doesn't matter what time frame, this is all going to be the same throughout any time frame. And so here's a few topics I do cover in my full in-depth course, and I just want to be transparent that these are left out of the mini series. However, you don't necessarily need to know this, but knowing this information will help you take your trading to the next level. And so I just want to let people know that there is more to this than the basic course. And so in the full market structure section of my course, I do go over swing structure, understanding swing highs and swing lows, fractal structure, which is understanding lower time frames without actually changing the time frame on your chart, and also multi-time frame analysis and combining those 2 points together. We also talk about premium and discount pricing, or go more in depth on what an actual range means and what it is. You'll probably hear me mention that a lot, the word range, but we talk a lot in depth about that in the full course. And so then we also obviously talk about putting it all together, top-down analysis, expectational order flow, and all of the rest of the pieces of this gigantic puzzle. By the way, if you want to watch this free mini course ad-free, you can check out the links below. There's a few links to where you can get a structured members area as well as ad-free content. And I just want to be clear that it is the same course that you're watching now. It's just ad-free, so you don't have to see ads on YouTube. Also, if you want to get a copy of the slides that you're watching, you can be sure to check out the links below as well. And you can get those for your notes for 100% free. There's no cost. You just have to sign in with your email at the link below, and you'll get those for free delivered to you from the entire course into your email. So make sure you subscribe to this channel and turn on your notifications so you can be one of the first ones to view the next episode in this course, where we're going to talk about market structure and applying that to live charts.